Welcome to World of DaaS, a show for data enthusiasts. I'm your host, Auren Hoffman, CEO of SafeGraph and GP of Flex Capital. For more conversations, videos, and transcripts, visit safegraph.com/podcasts. Hello, fellow data nerds. My guest today is Terry Kawaja. He's the CEO of Luma Partners, which is a media and technology investment bank. Terry has advised on over $300 billion in transactions, including some of the biggest deals in media, tech, and advertising. Terry, welcome to World of DaaS.
Great to be with you, Auren.
Excited to have a conversation with you. Now, economic uncertainty could be both a blessing and a curse when it comes to M&A. Like on the one hand, like acquirers have uncertainty, maybe they're less willing to buy. On the other hand, targets are much more willing to sell for reasonable prices. Like, how do you think that that trade happens, and how do you think that stacks up in 2023?
Yeah, I mean, I would say, generally speaking, that uncertainty is the enemy of deal making. Buyers are reluctant to find the trigger finger if they don't have a good handle on what they anticipate the future to be.
Yeah.
And we have lots of uncertainty, from the economy to interest rates, supply chain, the war in Iraq. The list goes on and on.
Cookies.
I think we're at peak uncertainty, kind of right now. Taiwan, and also, market change I would describe as having a lag factor, which is to say buyers tend to adjust value and expectations almost immediately, right? They just look at the public markets and see where things have traded off. Whereas sellers need a few quarters for the new reality to set in, the 5 stages of, denial, anger, bargaining, all that kind of stuff. And sellers are human. And so they're like, well, I wouldn't sell now. And then maybe, a few quarters later, when they realize this is the new reality, or wherever we kind of settle out, then you'll see deal making happen again. It's why we've seen a slowdown. So the data clearly shows we've seen a slowdown in the last couple of quarters, and yet we fully expect it should human patterns match what's happened in the past, which is, when you get such a substantial movement so fast, it takes sellers a few quarters to realize if this is the new reality, then that's simply what they have to deal with. The other thing is, I think we, step back a second and maybe with a broader lens on it, think about, what drives M&A, and it's largely change.
Yeah.
So, M&A is a strategy choice, whether it's organic growth or, build versus buy. You can also partner, but that tends to be temporary. And when change accelerates, like technology change, regulatory change, or market change, like we've all had recently, then companies tend to favor M&A. It sort of gets them to the market faster. And it was all that change in the marketing technology sector in the last few years that drove deal activity, programmatic adoption, data deprecation, privacy regulation, shift to streaming, e-commerce acceleration. All those factors are change agents that we believe will continue. So once we get past this sort of market reset, we expect activity to pick up again.
One of the good things about AdTech in general is that, like, the entire market changes every couple of years. Like, how you go about things, the whole technology stack changes. It's both good and bad, because it leaves a lot of players like holding a bag for, like, especially if they have more calcified technology. But it also means there's a lot of new players, there's a lot of new entrants that could come in. And I imagine that, like, that level of change in such a big industry, I don't think that's happening as much in, I don't know, oil and gas or something. That level of change in such a big industry can drive a lot of M&A.
100%. I'd put the time frame more like 6 months. I mean, everything changes in AdTech in 6 months. And it's one of the reasons that attracted me to this sector in the first instance, which is if you have a large, growing, fragmented, complex, and dynamic space, then that's a perfect opportunity for strategic advice.
Yep, that makes sense. Over the last few years, some of the acquirers have been these like private equity firms, and they've gotten more and more active, and we're writing bigger and bigger checks. Do you think that is going to continue, or do you think they will, just given all the other market uncertainty, that they will be less active in the next few years?
Yeah, you're right to observe that private equity's presence in the sector is relatively new. I'd say it largely picked
obviously
up about
DoubleClick back in the day they did,
Right.
which was probably the first real private equity success. But then it really hasn't happened as much.
But you're seeing it
yeah.
in big numbers in the last 5 years. And for
Yeah.
the last 2 years, private equity has actually been the largest buyer group in the sector.
Oh, I didn't know that. Okay,
So
interesting.
they actually lead it at this point. And I attribute that to just the gestation of the maturity of the industry. So if you look at the sector now, there are, you know, enough private equity appropriate targets, that is to say scale and profitability, that has attracted private equity. Going forward, I mean, this is like a phenomenal scenario for private equity, right?
Interest rates roll up opportunities.
Interest rates are more expensive than they were last year, but still historically low, and valuations are way off. So if you're a sector focused, you know, private equity firm with fresh capital to put to work and an investment thesis to pursue, it's now you got like a 50% off sale.
Yep. And there's and maybe like whereas like the classic strategic buyer might be a little bit more hesitant, the financial oriented buyer, like the private equity firm, might be potentially could be more aggressive.
More aggressive, more agile, and yet I don't. I want to make a distinction here. This isn't your grandfather's private equity. The people focused on the private equity firms focused on this sector tend to act quasi-strategic in the sense that, you know, they understand
they put a few things together
deeply. They put some things together, and they're playing more for multiple expansion necessarily than cost cutting and you know, net income you know, to just run the bottom line up.
Yeah, interesting. And you know, potentially also in a uncertain environment like it, you could see a scenario where it could make sense to consolidate a bit, where you could, you know, whether it's quote unquote the bad word, the roll up, or, you know, other ways of like of building a more diverse set of products, having a little bit more heft with the regulators, and the big regulators are Google and Apple, right? Those are the ultimate regulators that are out there. There's like the lesser regulators, which are like the EU and in the US, but being able to have a little bit more heft with the Google and Apples of the world. So do you see any of these things being able to drive basically people who want to get quote unquote bigger?
Absolutely. And in fact, you know, rarely do you have an industry sector the size of this one, right? It depends on how you want to cut it, but it's well over $1 trillion globally in marketing. And, you know, that's an enormous TAM. Yes, it is dominated by these large, big tech platforms, but even the, you know, the non-walled gardens is still an enormous market and growing, I might add, which is why it's attracted so much venture capital, so many companies. I mean, the whole premise of sort of creating a Lumascape 15 years ago when I did was to sort of, wait a second, get a handle on the fragmented sort of ecosystem and understand how all the players worked. I have long advocated that this industry, like every other industry, ought reasonably mature, rationalize, and consolidate such that we end up with fewer companies in the middle, with higher volumes and at lower take rates. In other words, kind of like everything else. Like look at ERP software. There were in the 80s, there was over 200 competitive ERP companies. Now there's 5 of any consequence. Many industries go through that kind of wave. This one hasn't really matured there.
And is that just because the change is happening too fast, as you mentioned, to bring that maturity in?
So I would attribute the sort of lack of end state consolidation as a function of, yes, it's the dynamics that you referenced, but also the fact that the TAM keeps growing. I mean, this is a sector. I mean, digital ad spend has grown over 20% for 25 years. Wow. Name me one other industry that has that persistent a growth rate. I don't think there is one.
Yeah. Okay. That's a really good point. That's really, and the other new thing that is like, well, it used to be new a while ago, but now is kind of new again, is just the number of public ad tech companies. I think there's about twice as number today than there were just a couple of years ago. How are these companies faring, and how do you think that's going to play out? Is that going to continue to be a trend, or you think we're kind of at peak number of public ad tech companies?
Yeah, we did see a rush to IPO last year. There were the number of public companies in the ad tech and martech space over doubled. And I think that was a function of backlog. I mean, so for many years, the IPO markets were closed and ad tech and martech were out of favor. And so there was no opportunity for scaling companies to access public markets. So when last year happened, and it was sort of tail of 2020 into 2021, we saw this sort of rush to file. Now, that might give one caution in terms of, are the right companies going public? But we would note that, we track these in we have these Luma indices, Luma A and Luma M, that track the ad tech and martech sectors. And the average net revenue growth of public companies in 2022 is 21%. And the average EBITDA margin is 25%, making that, if you think about the rule of 40, these companies are well over the rule of 40. So on average, I mean, these are actually pretty good companies. And I would attribute that as a function of that sort of growing TAM and that we referenced earlier. So these are pretty healthy companies. It's not a scenario where, you're about to see crash and burn all over the place if we see a pullback in ad spend.
Yeah, and they're profitable. And
they're healthy companies.
They're often they run pretty lean, and yes, they seem to be and often they're still very founder run, too.
For the large part.
Even when they're not founder run, it's like they kind of brought in a quasi founder often to run them, and so they have it's a little bit of a different than like the classic public company that's out there.
Yep, agreed.
Now there's plenty of SPACs that still have some dry powder, but that maybe didn't find their targets. But of course, SPACs are a little bit out of fashion. Like, how do you think that plays out? Do you think that's just over in today's market?
Our thought at the time, because we were even considering should we do a SPAC at Luma?
Right, of course. I mean, who wasn't?
Right? And exactly. And we came to the conclusion that SPACs are a bull market vehicle, just based on their structure, the way a trust shareholder has the opportunity to redeem at the de-SPACing and keep their warrant and get their cash back with interest, meant that if the market wasn't going up, then almost all of them would redeem, because even if they loved the issuer, they could simply redeem and then get their warrant and then buy the stock in the open market at, as it turns out, 50 or some cases 70% off.
Right.
We note that there's currently almost 600 SPACs with over $150 billion of dry powder. And when you lever that up, that's somewhere between $750 billion and $1 trillion worth of purchasing power. And I think it's a pretty safe bet to say that there's not that much in qualified targets to pursue. So there's going to be a whole bunch of crash and burn in the SPAC sector. And if you map when the SPACs are maturing, the midnight clock is Q1 of 2023. Yeah. So look out.
Now, you mentioned your ad tech and martech indices. The Luma indices are both down pretty significantly, as the whole market is.
Yep.
Over 2022. If you had to kind of like think about like the percentages, like, is this mostly just due to the market environment? Like, is this tracking the S&P 500, or is there something else that's like sector specific? Like, there's cookies, there's Apple, there's regulations, there's other things that maybe people are worried about.
Yeah, I think if you look at the data, right, you've got the NASDAQ is down about 21% year to date, and NASDAQ obviously skews towards tech, so call that a proxy for tech in general. And yet ad tech is down 49, like almost half off, right? 49%. So you could reasonably attribute the difference, or rough justice. Half of it is macro, half of it has to do with specific issues that are unique to ad tech that you made reference to. And I think probably the greatest one right now is the uncertainty with respect to targeting, audience-based targeting. So the ad industry about 12 years ago veered from placing ads on the basis of context, what the content was that you were viewing, and it switched to, because it was the first opportunity they actually had to have addressable information around who was seeing the ad, to target that user instead. And of course, there are certain tech platforms, there are certain signals, there's cookies, there's maids, there's a variety of signals that enable intermediaries and marketers to be able to target individuals on an audience basis. And that is changing. Privacy regulation is restricting what can be utilized, what can be known about people in particular on a third party basis. And perhaps greater is, Apple and Google are deprecating signals themselves. Now, it's kind of interesting. When Apple came out in 2021 and said, they announced their AdTech tracking transparency initiative, where they were basically going to cut off this signal of the user identity, even on an anonymous, basis or an aggregated basis. That was pretty crystal clear, and that led to a flood of M&A activity. Contrast that with Google, where they have now twice delayed.
They keep changing their mind about when they're doing
cookie deprecation approach, which is still very unclear. The whole sandbox initiative is sort of amorphous. We're not really sure what the substitute is to a cookie. And so I go back to uncertainty is the enemy of deal making, and that that creates uncertainty. That's why I don't think we've seen a lot of identity, based M&A in the last little while.
And just that one Apple change, like that had reverberations going all the way through. Like it really hurt the Facebook and Snap and other companies that you wouldn't necessarily have like thrown in the ad tech bucket if you were just the average investor, but it really hurt those companies going forward as well.
And let's not forget the principals, the marketers. I mean, the direct to consumer marketers there was such an explosion, right, of these new brands. And yes, their designs were probably a little better and they had clever marketing, but at the end of the day, their success was driven on pure math. The math of customer acquisition, so what's called CAC, customer acquisition cost, relative to LTV, lifetime value. So that CAC to LTV ratio was critical in determining how they could onboard new customers in an economically feasible way. That entirely depended on being able to do audience-based targeted marketing. With that,
and especially Apple was a very important piece of it, right?
Correct, because a lot of the conversion takes place in apps. And so with that deprecated, cut back, oh my God, we can see Facebook and Snap's impact in terms of their stock price. What we don't see, what isn't as obvious, is largely private companies. Actually, the few public ones are hurting, like Casper and but Peloton. But the private ones are sadly their businesses
so many of these things are going out of business, or they're massively cutting back, or some of them have laid off 80+% of people and really got down to a skeleton, and they're really just serving their core fans because the CACs are so high.
Because you live by the sword, you die by the sword, right? So when LTV to CAC flips on its head and is no longer economically viable. I mean, the good news is when it works incredibly well, and you don't actually limit the amount of campaign spend. You would just keep, drinking from the fire hose to accelerate growth. When the numbers get turn upside down, then no spending makes sense. So it becomes really challenging.
They had a two-prong issue, because one, they had the Apple change, which really hurt their business, and then they had they were also riding this COVID bump where just the demand was going up, so that your CACs were lower just by default because everyone was buying more stuff. Now that we've cut back, your CACs are just going to be much higher. Yeah,
the same way 2021 was a perfect storm in a positive direction. Now we have the inverse. You're absolutely right.
Interesting. Okay, well, LiveRamp, where I used to work, they're currently trading at 5-year low, despite still being like a core glue to the industry. Still the biggest player, where they're moving data between. Where do you think LiveRamp went wrong and over the last few years?
Look, We know and respect the folks at LiveRamp, and I think for companies like them, and I would put Criteo in that category as well.
Criteo as well. Great example. Yeah.
There is a perception in the market that they're particularly exposed to cookie deprecation. And so, I mean, if you look at where Criteo is trading, I mean, we sold them a company called Hook Logic that got them into the commerce media space, and they have decided to completely pivot to commerce media, which I think is a very smart strategy shift.
Hook Logic
on
was
their
a great
part.
company. Yeah.
But if you look at the numbers, they're trading purely on the value of that business, and their massive retargeting business that utilizes cookies is basically assumed to be worth zero. Which is, it's bizarre.
Yeah, which is still making a significant profit, I presume.
And it most certainly.
Interesting. What do you like as we kind of like head to, like, if we think about a recession, like marketing budgets are typically the first to be slashed. Performance advertising was somewhat resilient, I think, during the 2008 recession. But of course the digital advertising landscape was different. Like, how do you think, like, if we go into a recession, how do you think that plays into just the general marketing industry?
Well, let's clarify one thing. It's August 3rd, and the other day, the Fed report came out saying that we have had 2 quarters of declining GDP growth. So
we're in a recession.
Are in a recession.
Yeah, it might be mild, but we're
mild.
in a recession.
We'll see how severe it gets. Honestly, I don't care about the severity of any recession. I just don't want it to last long, because again, uncertainty. But yeah, if we're heading into a recession, then I'm certain that ad spend will suffer. It almost always does. You're right to point out that in the last turn down in 2008, 2009, digital was really just a niche performance channel, rather than now it's the largest media channel, encompassing a range of marketer objectives from both brand to performance. And if we go back and look at the last downturn, spending in every media channel was cut except for search. Search actually went up because it had highly attributable, provable ROI. So this one, I think, will be more of a balance. I don't think we'll totally escape the downturn, as was largely the case in 2008, because now digital advertising is the largest sector. So if the whole spending on advertising goes down, then the largest channel will likely suffer. Maybe not as much, because it's a mixture of both brand and performance, but I would expect there to be some impact. Yeah.
It's sometimes like recessions cause people to move into new technologies that are a little bit more unproven, but are much more cost effective. And when things are good, they may have not wanted to go there. Like, I remember in 2001, all these companies basically jettisoned their Sun machines and went to Linux, because it was just and then, in 2008, as you mentioned, a lot of companies really found religion on digital advertising because it was cheaper, and they may have just like been drinking out of the old school Kool-Aid beforehand, and then much more aggressively moved into it. Is there some analogy you think that could happen now, where there's like these particular types of technologies that maybe were a bit unproven or a little bit riskier, but are probably more cost effective, and we'll see more dollars flow into those?
I think most definitely, right? I mean, as we previously said, this is an agile industry that is always on the go, on the change, on the innovation curve of trying to figure out what works or what works better. Look, some basic premises. Advertising is not going away.
Yep.
And I would even go further and say specifically targeted advertising is not going away. So there will be workarounds, right? The privacy folks are concerned with unconsented utilization of someone's identity for purposes of targeting. I could quibble with that. I've got a whole thesis on how the whole privacy thing was poorly handled by the industry, and how it's not the big demon that. The weird thing about privacy is the folks that are pursuing the restrictions are doing so as a proxy for consumers, saying consumers are upset. It's not clear consumers are upset, actually. When you look at habits, whether it's the opt-ins and pursuant to on publishers from the GDPR sort of restrictions, it looks like most people, and in particular young people, are like, willing to participate in the sort of trade-off, if you will, the value exchange between some form of anonymous identity about who they are, maybe rough demographics or interest in return for a value proposition.
Sorry, but just a quick to jump in, but like when privacy things are on the ballot, like in the California, like they do tend to pass though, right? So consumers do find broad, like if you ask consumers broadly, do you want privacy? They're probably gonna say, I assume they're gonna say yes, right?
Yes, and I think that's a function of conflating all the issues. It's like it to me, it's like
safety. I want to be safe. Yeah.
Right. Well, it's like immigration, right? There's people flooding over the Mexican border, and then there's H-1B, engineering graduate school folks, and both of those are under the guise of immigration. Whereas, like privacy, if someone loses your file, someone leaks your file of PII data, and people know all about
the dark web,
that's privacy. And guess what? An anonymous identifier that gives marketers a rough idea of what you might be interested in is also privacy. So a lot of it depends on how it's worded and so forth. But yes, getting back to your original question, I think there's going to be opportunities in contextual as that gets revamped. I think first party matching, you've seen clean rooms, come to mind as an innovative sort of technology to both continue the sort of audience-based targeting and yet preserve that data to make sure it doesn't get loose in the internet. And let's not forget creative. I mean, I'm of the view that this industry spends way too much time optimizing efficiency when they should spend more time on efficacy. Yeah. And this is where I think creative tech can play a big role in that.
Okay. Yeah, that's a really good point. And certainly with like, if classically with Google ads, like there's the efficiency of like what ads should what keyword should I target, but the creative, like essentially what should I put in the ad is just as important. And then of course the creative on the landing page once you go is really important too. So you have these kind of like three pieces. There's the efficiency side, but there's also the creative side, and that one, I think everyone in the industry kind of understands that. And of course, like TV, people have been understanding creative for a really long time.
Yeah, but think of the three components of an ad, right? There are three components of an ad. There's the media, so where the ad is going to show up.
Yep.
There's the data, the audience, who's going to see it, and then the creative. We have seen a flood of innovation and deal making in the first two, in media and data. It's basically crickets. It's been crickets in creative, and I think
maybe a little bit of A/B testing.
Yeah, a little bit of that stuff, but I mean, and those are all small ball deals. But I think there's a great unlock here by leveraging technology on the creative side, again, to focus on efficacy as opposed to efficiency. I think of it as an iceberg, right? You see the part you see above the water is efficiency, and because everyone can see that and everyone can measure that, marginal incremental improvements on that is what everyone across the Lumascapes seems to be focused on, whereas 9/10 of that iceberg is underwater. That's creative, that's efficacy down there.
No, there's these major players, right? There's Apple, Google, maybe to a lesser extent Facebook, that are out there, and then there's a lot of antitrust calls in that, maybe throw Amazon as well. Do you think there's going to be any meaningful action, and in either case, do you think that will affect the marketing landscape?
So let me start off by saying I certainly hope so. I mean, I see far greater harm to consumers in the antitrust imbalance than privacy, and yet all the attention and legislative action historically has been focused on the latter. That has changed.
Yeah, and by the way, that I presume because the people driving the agenda would be these bigger companies, and it's much better for them to focus it on the privacy than to focus it on antitrust.
Oh, 100%. I mean, why is Google delaying cookie deprecation? Well, because I think they're more worried about antitrust than they are about privacy. Privacy and antitrust are a double-edged sword, right? If you move in one direction to enhance privacy, you are exacerbating the antitrust problem. And it's that imbalance, I think, net in the long run hurts consumers pretty severely. So I certainly hope we do see movement. leadership out of the EU for sure. Belgium, the UK, and the EU in general seem to be very focused on antitrust. They're more toothless, compared to, say, Congress here. And there's lots of reasons to be skeptical that Congress will actually get anything effective passed, but I certainly hope so.
Well, and you don't have to actually pass a quote unquote, you don't have to break these companies up, but by looking into it a little bit more, they might be a little bit more likely to let competition happen, or I would presume, right? I think, obviously, like if you think of like past antitrust things, maybe didn't break the companies up, but maybe help that company be a little bit more open to competition.
Just the scrutiny alone can have a positive impact. So we'll see.
Now, you've spoken a lot at length about how, the challenges to the industry around ID deprecation haven't really been addressed. Like, where do you see that going?
Yeah, I mean, I think, again, if we're going to perpetuate some form of targeted advertising, that will be necessary. I hope this is not like a Thelma and Louise moment for AdTech, though. We've been there many times before. I mean, since I've been focused on the sector for 17 years, people have been calling for the death of AdTech, and yet it continues to survive and thrive despite these, seems like annual existential threats. So at a certain point, you tend to have more faith in the resiliency of the sector than the naysayers. That's just based on pattern recognition. But I will say that it's not clear to me that we have in hand a replacement for the cookie for identity, right? The notion of UID 2.0 or using one's email. I don't know. I hear that and say, wait, if privacy folks are up in arms about an anonymous 10-digit identifier, am I more upset about an associated amount of proclivities and interests associated with 192.27.534.28 or Kawaja at lumapartners.com?
Right.
The latter feels to be far more privacy invasive.
Yeah. Okay. That's a really good point. And when you think of like being an investor, like if I think of my own investing experience in AdTech, like it's been very positive. And I would say the companies broadly that I've invested in have done super well. And I think generally AdTech, if you're an investor, let's say an angel investor in some of these companies, you've done incredibly well. The way when I start to look at my own portfolio, I start thinking, okay, there's like in AdTech, there's still companies that are a bit more on the ad side, and there's companies who are a bit more on the tech side. And while both of them together have done well, the companies I invested in that were more on the tech side have done just incredibly well. And the companies on the ad side have done okay. How do you kind of think of the market when you think about like the broader ad tech market?
Yeah, we definitely look at companies and try to discern, what their underlying business models are and how much inherent operating leverage is in those business models. There is a tendency that, media has lower operating leverage than technology per se. It's almost like, you got media low, and then data, and then software. So it tends to be, stratified. And historically, if you look at valuation multiples, those reflect those relative operating leverage levels. So I think, you've done well because you're an insider. You understand how it works. We have to pick our clients, wisely as well. And I'd say, done a very good job because we understand, what's going on. It's not for the faint of heart, because of the fragmentation. A lot of those companies go to zero, but probably not the ones that well-informed investors are putting money into.
And when you think of like all of these like amazing entrepreneurs, you mentioned Hook Logic, Jonathan Updike, who I think is just like an incredibly talented person. If you just go through like all these different ad tech M&A, Brian O'Kelly, Ari Paparo, like if you go, and obviously even the public companies, Jeff Green, like you just have these like incredibly talented people. Like, why have all these people just shown up in ad tech? Is it just because like, okay, this is where the money is, and that's it? Like, it doesn't seem like like necessarily a place that you would expect to attract all these talented folks.
Yeah, I mean, Elon Musk, one of the greatest, entrepreneurs alive, even including the last 4 months. PayPal, right? He started in fintech and optimizing,
Yeah.
something on the
Or
enterprise
Zip
side.
too. Yeah. Even
Zip
before that.
too,
Yeah. Yeah.
exactly. Yeah, I mean, again, I go back to there are very few industries with the kind of scale of the TAM, and the dynamics such that if you have confidence that you can build a product that does a better is a better mousetrap, then you have opportunities to make a difference and create a lot of value.
Cool. Now, a couple.
And you're absolutely right. The entrepreneur, there are some phenomenal entrepreneurs in this industry. It's kind of probably why I'm sticking around, is because it's just fascinating to work with these brilliant minds.
Yeah, it's fun. These people are they're super fun. Now, a couple personal questions. Now, you're a very specialized professional, right? You've been a banker for a super long time. And of course, we had David Epstein on, who's a guest recently at World of DaaS, and he talked about why generalists will win over specialists in today's world. What's your take on this?
Yeah, so I have a bit of a different take than just the generalist versus specialist. I'm a big believer in two concepts: optionality and comparative advantage. In fact, I think most people undervalue optionality in life. The approach I espouse is to sort of develop what I call transferable skill sets early in one's career. So specializing helps you develop comparative advantage that can really accelerate your career. In my case, I developed transferable skill sets like valuation and negotiation, but as it so happens, I stayed as a strategic advisory intermediary role my whole career because I love it and I get variety, but I still had those transferable skill sets should I choose to do something else. So it's a combination of some form of specialization while maintaining optionality. And I think, even at my firm, Luma, our comparative advantage due to specialization in a complex and dynamic sector has had massive benefits. And there is zero chance I would have gotten this far as a generalist M&A advisor.
No, you mentioned you just mentioned something I thought was interesting, like that you think optionality is undervalued. At least from my standpoint, I would say the opposite. I'd say, at least for smart people, most smart people way overvalue optionality, and they're always doing things to try to figure out ways to increase their options rather than more narrowing down on things. So they go to law school not because they love the law, but because, well, it gives me some optionality. They go to McKinsey, not because it's well, McKinsey will give me some optionality. It looks good in my resume. And they keep stacking things on their resume that quote unquote look good, but don't necessarily drive them anywhere. And even if you think of the ultimate thing, they stay single much longer as well, which is the ultimate optionality as well. You're raising your hand. Is that you too? Or
yeah, I got married at 41 for the first time.
Okay, there you go. Okay, all right.
So yeah, I mean that's the other side of the coin, right? You I think maybe both are right. In the sense that I don't know, I had a politician, businessman, lawyer who addressed a class in my business school, and someone asked the question about, of your three careers, which one, would you recommend? And he said, do it all, do everything, have a career, then have another career, then have another career. Optionality is, diversity is the spice of life. So maybe that's where I got my notions of optionality.
Now, you have this quote that I love. You said there's more money to be made in ideas than in billable hours. Can you unpack that a bit?
Well, that's really about operating leverage, right? Yep. A concept that I admit I am obsessed about. I'm an optimizer, an internal optimizer, and maybe, see optionality above. And I apply it to almost every aspect of my life. And by the way, both positive and negative, right? I mean, I got to be honest. I over optimize things, and I think about optimizing.
Taylor, when he was, I forgot his first name. I think Frederick Taylor, and he was the super optimizer 100 years ago. And he was the guy who like actually went to the factories to try to like optimize it. But he was like such an optimizer that he tried to shave with 2 razors at the same time, and then realized like it was just taking way more time because he was bleeding all over the place afterwards.
It's like, in New York, classic example. I mean, when I get on a subway, I think about where the exit is in the stop that I'm going to get off, and I migrate to the car that I think minimizes my steps on the other side, because
Yep.
movement on the starting platform before the train arrives is not on the critical path, whereas movement after the train arrives at its destination is on the critical path.
Of course,
So
makes sense. Yeah,
I
you're like,
mean,
I got to get in a car 5. I know that's going to be the most optimal place.
correct. And it's not like it's preoccupying my cortical front. Like it's not like I just automatically do that.
Yeah.
And it drives my wife crazy. I'm like, let's go down. She doesn't drive the subway anymore, but like if I do something, they're like, why are you parking here? And I'm like, well, if you think about it, she goes, you're nuts. Like, what is going on in your head? And it's I can't control it. There's no off switch. So
All right. No, you're very well known for
so your
Yeah.
question about
Yeah.
so the question about billable hours is all about operating leverage. And yes, I knowingly launched Luma, which is a strategic advisory firm, which arguably has low operating leverage. But the way we've kind of done our go to market, we have higher operating leverage. We have different numbers. If I showed you my financials, you would not guess that it was an advisory firm. It looks more like a software firm.
Yeah, amazing. Now you're really well known. One of the things you're well known for is bringing humor into your Luma presentations, into your YouTube, into your Twitter feeds. Like, is it just life's too short not to have fun?
Well, I mean, look, I have been an investment banker for a long time, but I've been a comedian for longer. So I would suggest, look, it's in my nature, and it looks. So I'm going to do that because I'm doing that for me, not for anyone else. And yet, as it turns out, it's got some benefits, right? I mean, people can smell authenticity. So if I'm all straight laced, I probably wouldn't feel like me. And when I'm sort of being me and joking around and stuff like that, you come across as more authentic. I think it's a big differentiator. I mean, bankers tend to be pretty dry humans, and
bankers and corporate lawyers, you don't expect a lot of humor coming.
So if you're sort of bring a little levity into a
too.
situation. Look, we take our day job seriously. We just don't take ourselves too seriously. And then maybe a third one is sometimes if you and I sort of have been accused of having no filter. And I think in the long run, that's a good thing. But, as an intermediary, it can get you in trouble. And I think that if you can wrap some harsh news in, with a comedic wrapper, it's like a spoonful of sugar helps the medicine go down kind of thing.
All right. That
so
makes a lot of
in
sense.
my presentations, when I'm talking about some cataclysmic thing, often it's done in a humorous way so that, the audience reaction is, oh, shit.
All right. Last question we ask all of our guests. What conventional wisdom or advice do you think is generally bad advice?
So in particular here in the United States of America, because I came from Canada, the premise that a lot of folks that adopt the sort of the capitalist way of life aspire to is get rich as fast as possible. Get success, speed is the answer, like do it sooner, faster. And my motto is get rich slowly.
Yeah, that was just the Warren Buffett motto as well.
Because what happens when you get there too fast? I mean, I don't know. And maybe it's my lack of faith in my own ability to be responsible or something. But I just think, if the way you get rich slowly, if you're doing what you enjoy doing, then you have meaning and purpose along the journey, and you'll get there. And again, if you're exercising, diet, and you've got some luck on the gene pool, then you're probably going to live a lot longer than you anticipated. So get rich slowly, enjoy the journey. They always say enjoy the journey, but how does that manifest itself? don't worry about the, end outcome. It'll get there. So long as you're on a track to get there eventually, then that's cool.
Yeah, it's funny. I talked to a lot of people who are, let's say, around 30 years old, and a lot of smart, ambitious people. They're like, I'm not where I want to be. I'm not a super multimillionaire. I'm not running this huge company yet, or something like that. It does feel like it weighs on a lot of people. Like there's some sort of expectation, either that they had in their head or society's expectation of them because they went to
100%.
Harvard or something like that they should be doing something much bigger.
And I think a lot of it is self-imposed.
Yeah.
I think we think that society's thinking that. The reality is no one is thinking about you.
Yes. Right.
As the famous quote from Don Draper.
Yeah.
Yeah. Except for your Jewish mother. Yeah. The classic Don Draper line, which I use all the time, is sorry to hate to break this to you, but the universe is indifferent.
All right. Well, thank you, Terry Kawaja, for being with us on World of DaaS. I follow you on T Kawaja on Twitter. Is that the best place for our listeners to stay up to date on all your musings?
Yeah, I can be found on Twitter. You can, if you're interested in comedy, you can check out my parodies on my YouTube channel. It's just search for my name. And for industry content, we post a lot of materials on our website, lumapartners.com.
Amazing. All right. Thank you, Terry. Thank you so much for being a guest on World of DaaS.
Great to chat with you, Auren.